Well, it looks like we have just about everybody who is planning to join for today. So with that, good morning and welcome to our webinar about after-tax rollovers and mega backdoor Roth. This is actually one of my favorite planning strategies. I'm really excited to discuss it with everybody. So with that, why don't we go ahead and get started? My name, Patrick Marcinko. I am one of the financial advisors here at Bogart Wealth. I'm also a certified financial planner. At its core, I really work with families on developing ultimately a path forward that aligns their money with their life goals and aspirations. Now, for those of you who might be new to Bogart, we were founded in 2016, and our mission is pretty simple. It's to help our clients with their financial challenges through comprehensive financial planning. We have a team of about 50 employees across the country where we manage approximately $3.1 billion of assets under management, working with approximately 1,400 households, with a particular focus on Fortune 500 executives. Now, one of the unique aspects about Bogart is we are a registered investment advisor, which means we're an independent fiduciary advisor working in our client's best interest. We custody our assets at Charles Schwab, and like I mentioned, we are a fee-only wealth management firm. 3 offices for Bogart. So McLean, Virginia, where our headquarters is. I'm sitting here today. We also have 2 offices in Houston, one in Gessner, as well as one in the Woodlands. So with that, let's go ahead and get started on our agenda. So agenda for today, pretty simple. We're going to start off talking about the type of retirement plans, then go into Roth conversion basics, mega backdoor, in-plan Roth conversions, and then ultimately talk about after-tax withdrawals. So towards the end of today's call, we'll also go through some examples as a part of that. But let's go ahead and jump in. So today, I really want to start and talk about qualified retirement accounts. Now, these are your standard retirement accounts that most people are familiar with. The most common example is the 401k. IRAs are also considered traditional IRAs, Roth IRAs, or qualified accounts. And some people may even have what's called a 403b or a 457 plan. Now, 403bs are typically associated with nonprofits. 457s are offered through the government employers. And throughout this presentation today, what you're going to hear is me use these terms of retirement accounts, 401ks, interchangeably. And I do that because most people we work with tend to have a 401k. So if you hear me talk about the 401k, just understand, in general, I'm talking about qualified retirement accounts. Now, there are several advantages to these types of accounts. First is your retirement contributions are made on a pre-tax basis, which what that effectively means is that your salary is going to be reduced by the amount you contribute before taxes are applied, which ultimately allows you to save at your highest marginal tax rate every year while also building retirement savings. It's kind of a unique process. Another benefit is that the gains and appreciation and dividends inside the account, all of that growth is happening tax deferred. You do not pay taxes on any of these items until you make a withdrawal in retirement, or any withdrawal for that matter. In addition, a lot of your employers, like ExxonMobil, offer a company match on traditional 401k contributions, which is essentially free money toward your retirement. However, there are some important considerations that it's very key to note with these qualified accounts. One is the early withdrawal penalty. You'll hear us talk about this multiple times today. If you take out money before 59 and a half, the IRS will generally, there are some exceptions, but generally impose a 10% penalty on top of the regular taxes you would owe. So this is a really big one. We'll hit on this a little bit later. Another key point is that every dollar withdrawn, every single one, both your original contributions and all of the growth, is going to be taxed as ordinary income. That means that withdrawals are taxed at your normal marginal income tax rate. Very big deal. We'll also dive into that in a little bit. And lastly, required minimum distributions apply here. And this is where the government, through legislation, has created a specific formula that dictates when and ultimately how much you need to withdraw from these accounts, because once you withdraw, it creates a taxable event for them to collect revenues. For most people today, when I talk about RMDs, we're going to be talking about them beginning at your age 75. Although the exact age can depend on your birth year, but for most people today, it's going to be 75. And finally, I just want to make this very clear. It's very important to follow the required schedule, because if you fail to take your RMD on time, it can be a substantial penalty. So if you have any questions about your RMD, what to do with it, please contact your advisor. They would be more than happy to help. Moving right along here, so let's talk about contributions for employer-sponsored plans. These are qualified accounts. They do have caps on how much you can contribute. Now, 403Bs, 401Ks, Roth 401Ks, the employer deferral limit for this year, $23,500, the maximum amount that you as a participant can contribute directly from your salary or a pre-tax or Roth basis. Now, for those that are 50 or older, you this year would be eligible for an additional catch-up contribution, $7,500. It essentially allows you to put a little bit more towards retirement. And it is very key to understand that these numbers I've just mentioned only represent the employee deferral portion. There is also a contribution limit for defined contribution plans, which includes all sources of contributions. So in 2025, that limit is $70,000 for those that are 50 or older, $77,500. Now, what does all sources mean? What it means is it's inclusive of your employee deferrals, your after-tax contributions, your Roth contributions, and the employer match. So the combined amount of all those sources has to be less than either $70,000 or $77,500 with this catch-up. And so that is the maximum amount that can be deposited into your account in 2025. These amounts do have an index for inflation. So we do anticipate changes not only next year, but the years following. So let's switch gears here. Traditional Roth accounts. Okay, another type of qualified retirement account, the traditional IRA. Like I mentioned, individual retirement account, traditional IRAs are funded with pre-tax dollars, meaning that your contributions are made before taxes and can potentially reduce your income for that year. Now, there are annual contribution limits, just like the plans we just spoke about for IRAs. If you're 50 or younger, if you're under 50, the limit's going to be $7,000. If you're 50 or older, you get an extra $1,000 and a catch-up, say total of $8,000. Now, if you do not plan to deduct your IRA contribution from taxable income, there's no income limit. You can contribute the full amount. However, one of the key benefits of a traditional is the ability to deduct income your contributions from your taxable income. And this deduction is ultimately subject to income phase-out ranges. And those ranges depend on your filing status, whether you're covered by a plan, et cetera, et cetera. So if you are covered by a workplace plan, you file single, there is a phase-out, right? 79 to 89. If you're married filing taxes, you are personally covered by a retirement plan as well. That deduction is 126 to 146. So it can be, pretty substantial kind of ranges here for us to consider. So, and give me one second. So, and within those ranges, what happens is you essentially have kind of a proration of how much you can deduct. But again, if you don't deduct the traditional contributions, there is no income limit. So, bringing this together, I've actually pulled here the tax bracket table. So you can see the differing filing statuses, the impact that that makes. But the big takeaway from this is that our tax system operates using a progressive structure. And it's helpful to understand this concept when we talk about contributions and withdrawals. And so let's take, for example, the married filing jointly bracket. If your household income is less than $23,850, every dollar up to that amount, it's 10%, right? Now, because the entire bucket is taxed at the same rate, your average tax rate is also the same amount. It's 10%. Well, any dollars earned above the first bucket and below the 96,950 fall into the next bracket, which would be 12%. When you combine a portion of it's being taxed at 10, a portion is now 12, you can get an average tax rate that no longer matches your top tax bracket, and that process continues. So this progressive system becomes especially important when we talk about 401k contributions and future withdrawals, because contributions to your retirement account are often made at your marginal or the highest tax bracket that applies to the last dollar you earned. However, withdrawals are the opposite in retirement. Withdrawals are taxed at your average tax rate, which is typically lower because it ultimately reflects all the brackets filled below your top bracket. And so the difference between your marginal and your average tax rates is exactly why understanding the tax bracket structure matters when we're thinking about where to contribute and ultimately where to distribute from your retirement assets. And so in addition to the traditional, and a big part of the integration with this tax bracket now becomes the Roth IRAs. And many 401k programs as well, just want to note, also have a Roth bucket. Now, Roth accounts become valuable because they're made with after-tax dollars, meaning that you pay the tax up front rather than in retirement. And typically, for a lot of people, the employer match the company offers, so, whether it's 7% or whatnot, is still actually pre-tax though. Even though that some employers have begun to allow Roth 401k contributions, for most people, employer matches is pre-tax. Now, there is some programs that are offering a Roth employer match, but it's not standard yet at this point. So the main reason that we really like these Roth accounts is because both Roth IRAs, Roth 401ks, the Roth buckets benefit from tax-free growth on the invested money. In addition, you can take the principal, the dollars you contributed, out as well. And so you receive this tax-free withdrawal of growth as long as two key things are met on the slide here. The first is the attainment of age 59 and a half. If you're 59 and a half and older, that's a big box to check. The second is you must have had a Roth account that existed at least 5 calendar years. This is very, very important to factor in. Now, if the gains or appreciation are withdrawn before either of these requirements, that's where that penalty is going to get you again. So if you have any questions on that, whether you've hit the 2 check boxes to get a tax-free distribution, please let us know. We're more than happy to help. Another major advantage of Roth IRAs is that they are not subject to what I mentioned earlier, which was the required minimum distributions. This makes them excellent planning tools, especially for individuals who already have significant pre-tax assets in a 401k or an IRA. Many people will actually perform Roth conversions, which we'll talk about in a little bit, to reduce the amount of money included for those RMDs in the future. RMDs are a really big planning agenda item that folks should be talking with their retirement advisor on. Now, the Roth 401k is a little different because they exist within an employer retirement plan. They may still be subject to RMDs unless the assets are rolled into a Roth IRA after you retire. So just to kind of the main takeaway from this slide, we've covered a lot. Roth assets, very attractive for legacy planning because the beneficiaries will inherit those monies tax-free, which is a really big advantage as well. But the big thing is you meet those 2 check boxes, we're looking at tax-free growth. So let's shift gears a little bit and talk about the Roth IRA. There are also Roth IRA contribution limits. Limits are the same for traditional, $7,000 if you're under 50, over 50, you get the extra $1,000. However, it is more difficult to contribute directly to a Roth if you are a high income earner. Unlike traditional IRAs where you can contribute regardless of income, even though that may impact your tax deduction, Roth IRAs have a very strict income phase out, and they can completely eliminate your ability to contribute. So if you file as single, you're phased out of making Roth IRA contributions once your income hits $165,000. If you're married, that's $246,000. And once you pass those ranges, you can't make a direct Roth IRA contribution anymore. And so it's important to make a distinction between contributions, though, and conversions. The income limits only apply to direct contributions. There are no income limits on Roth conversions. In theory, you can convert as much money as you want from a pre-tax account to a Roth account in a single year. You just got to be ready to pay that tax bill, and we'll discuss that in a little bit. So Roth conversions, no income limit. Roth IRAs, relatively strict income limits. So, all right, the basics of Roth conversions, we've kind of danced around this a little bit. A Roth conversion is a penalty-free but taxable transfer of money from a traditional IRA to a Roth IRA. You can convert all the assets in the traditional IRA or just a portion of them. Most people just convert a portion. The key here is any amount you convert is taxed as ordinary income in the year of the conversion. So if you do a conversion today, you are going to have ordinary income in tax year 2025. So you must be willing to pay the associated taxes. Prior to 2010, Roth conversions were restricted. You were only eligible to convert if your modified adjusted gross income was below $100,000. If you earned more than that, you couldn't really do it. But that was removed. It's no longer applied. So now there's essentially no income limit on Roth conversions. You can convert as much as you want in any given year, as long as you're prepared to pay the taxes. In addition to converting traditional IRAs, depending on the plan, you do want to check this with your advisor, but that could also expand to 403Bs, SEP IRAs, simple IRAs, et cetera, et cetera. So let's shift gears and kind of keep going on this reasons to convert, right? So when we think about why you might choose to do a Roth conversion, one of the real reasons is Roth contributions, let me back up one second. For regular contributions to a Roth IRA, they're allowed at any age as long as you have earned income. Another major advantage is that a Roth, IRA is completely income tax free as long as you hit those two things, right? 15.5 and the 5-year rule. And so both your principal as well as growth can be withdrawn without any taxes. In addition, Roth IRAs are not subject to required minimum distributions. And so here are kind of some reasons why we'd want to think about doing a Roth conversion. Number one, we're going to diversify our tax exposure. That's a really big one. There are several types of money you can hold pre-tax, which is your 401ks, taxable brokerage accounts, then Roth money. And for many high-income earners, access to this Roth bucket is going to be limited for years because of income restrictions on these contributions that we've been talking about. So performing Roth conversions is a way for those group of individuals to build up a bucket of tax-free assets, which is ultimately very powerful for long-term planning. Another reason converting can make sense is if your income was too high to do direct contributions, that kind of is a given. Another reason is that if you believe tax rates will be higher in the future, in that case, you may prefer to pay taxes now as to what you believe could be a lower rate, then enjoy tax-free withdrawals later. And finally, Roth conversions can play a major role in transferring wealth to your children. Inheriting Roth dollars is always going to be, I shouldn't say always, most of the time, more favorable than inheriting pre-tax retirement dollars because beneficiaries do not owe taxes on Roth withdrawals. Even though most inherited retirement accounts must be emptied within 10 years of an owner's passing, with a Roth IRA, that rule is less burdensome. The reason being is because while the account must still be drawn down, the withdrawals from a legacy perspective are now tax-free. Whereas if you had a pre-tax IRA or a 401k, that would trigger taxable income for your beneficiaries each time you take that money out. So continuing, let's look at some of the factors that we may consider, right? So the short answer is the best option heavily will depend on your personal financial situation, your income, spending patterns, long-term goals. All of those will influence whether or not you should convert. So first, if you believe, like I said, income tax rates will be higher in the future and may make sense to pay taxes on Roth conversions now. Second, if you expect your income and spending to rise significantly faster than inflation between now and retirement, converting Roth dollars now can be advantageous because you can lock in today's tax rates. Third, if you're concerned about future RMDs, sometimes we'll actually refer to this as kind of an RMD surplus, where you have too much RMDs. Roth contribution or conversion can help in this case because with folks that have very large pre-tax retirement assets, doing these Roth conversions can help reduce that tax liability, moving some of those to the Roth bucket, avoiding that subject to RMDs. Ultimately, this just gives our retirees more flexibility and tax efficiency within their plan. So, okay, in-plan Roth conversions. This is a big one. So, let's dive into one of the key kind of components of this, which is ultimately in-plan conversions versus tax-paid withdrawals. Sometimes this will be referred to, and it'll be often referred to in today's conversation as mega backdoor Roth. And so what this section really sets the stage for is understanding how these after-tax contributions in your 401k can be moved into a Roth account. So for the in-plan conversion, this is the process of converting the after-tax balance in your 401k or your savings plan into the Roth bucket. But I do want to say before we kind of dive into this further, it is very important to consider the implications for your net unrealized appreciation strategy. As with many of the topics that we've discussed, the best approach depends on your personal situation, the size of your retirement accounts, and your overall financial plan. So before we get into these in-plan conversions, I do want to note that it's very important to consider the potential ripple effect of doing these in-plan conversions. Now, a tax-paid withdrawal is very different from an in-plan conversion. In-plan conversions can have some unexpected consequences, so understanding this is really, really key. For employees that are younger than 15 and a half, they can convert all or a portion of their after-tax contributions to their Roth conversion account. However, funds in the pre-tax portion of the account cannot be converted at this age. Employees older than 15 and a half may be able to convert all or a portion of their non-Roth accounts to the Roth conversion account. And a common question we'll often hear is kind of what happens to the employer stock, like ExxonMobil stock, and how basis will play into the calculation. Well, for tax purposes, the basis of your shares in a pre-tax account doesn't actually make a material difference. Even though the contributions may have a cost basis assigned to them internally, everything in the pre-tax account is taxed as ordinary income when withdrawn or converted. The gains are not treated separately. Cost basis does not influence the taxation. And so here's an example to kind of illustrate how this works with a in-plan conversion. So suppose your after-tax balance is 60% contributions, 40% growth. If you convert 100%, 40% is going to be taxable as ordinary income in the year of conversion. So when we think about in-plan Roth conversion, so converting the tax-paid balance, again, it's very important to consider the implications of your net unrealized appreciation. And so what you'll notice here is that when we're withdrawing the tax-paid credit from the savings plan and putting it into a Roth IRA out of the savings plan, we actually must factor in the gain that's also attributable to the component here. So when we're thinking about this, we're looking at the 270 of contributions with that delta being the after-tax account. So you can see that those after-tax contributions of $270,000 have actually grown now to $562,000. So within the after-tax account, we have gains, but we're really focusing on what is the 270 of contributions here. So if we're looking at this another way, and sorry, my screen is locking up on me. So we have this tax paid amount, right? What your contributions were, which was the 274, the after-tax balance, which is 562. These have to be rolled over directly to a Roth IRA and a traditional IRA. And if they're rolled over to those accounts, we don't have a taxable event. And so with that being said, one of the things that is helpful with that is where an in-plan conversion creates a taxable liability, the tax paid withdrawal here does not. And so we have to take, though, a pro rata portion of this contribution. So we cannot just take out the 274 and put it in a Roth IRA. We have this pro rata portion. You get that pro rata portion, you take the 274, divide it by the 562, well, you get that percentage, and then you multiply that percentage times 274. That gets you over into how much you can put into the Roth IRA versus the traditional IRA. So typically when you do this mega backdoor rollover, you do get two checks from your 401k program. You get a traditional check as well as a Roth check. And sometimes if you're speaking to your 401k group, this will be called the tax paid withdrawal maximum allowable with no suspension. So a little taxable, but, a little complicated, but that's kind of the technical term. So, okay. Let's look at the mega backdoor Roth example here. So base salary, $235,000. Their top tax bracket is 24%. They're contributing 10%, and then the after-tax contributions, 5%. In this case, this employee is over the age of 50, and so they can actually do a catch-up contribution, $625 a month. This also assumes that they can do a company match of 7%. And so what that translates into is you have pre-tax contributions of $23,500. The after-tax contributions now become, with 5%, $11,750. The catch-up becomes $7,500, company match. So in short, right, we get $59,200 into the plan. Now, remember, this is actually a lot more than what the $7,000 direct limit is, or essentially zero if your income is over $240,000. So it really becomes advantageous where you can essentially expand how much you can get into Roth as opposed to direct Roth contributions. Now, when we think about the limit, right, our limit in this case is $77,500. That's the combination of pre-tax, Roth, after-tax catch-up company match. Some employers will actually allow what's called a special contribution. So in this case, you can put in an additional $18,300 to get you to a max eligible mega backdoor of $30,000. And this is really where kind of the mechanics of this come in. We have the after-tax contributions of $30,500. They take a pit stop. That becomes kind of the front door deposit, and then we move those over to a Roth IRA. It doesn't happen one-to-one in this because we talked about the pro rata portion of this, but just to give you an idea, we're putting after-tax contributions in a pre-tax bucket, and then we're just moving that over into a Roth bucket. The benefit of that, again, is the growth from that point going forward is tax-free. What this ultimately translates to, as you can see here, pretty easy example, 10 years of doing the mega backdoor at a 6% growth rate. We have total contributions $300,000. Well, we've created, with a 6% growth rate, a $96,000 tax-free gain embedded in this example. So it can be really, really profound doing this year over year, and these numbers only compound the longer that we're doing the mega backdoor. So let's look at another example. Base salary, $400,000. Marginal tax bracket's 32%. Pre-tax, they're contributing 5.875%. After tax, 5%. The catch-up is $625, 7% match. They're also over 70, hence the catch-up. So if we look at that, that translates into $23,500 plus the Roth of zero in this case, $20,000 for after tax, catch-up $7,500, match has increased, but that gets us to $75,000, right? So this employee is able to contribute a lot more, but they haven't hit the max though. And so if you look, what you're really kind of factoring into this is, okay, our cap is $77,500. We are $75,500. We can do a special contribution of $2,000 after tax, which brings our maximum eligible mega backdoor to $22,000. So if we compound that going forward, and this is the same process, right? Kind of after tax to traditional Roth. But if we compound that, I'm going to skip to the slide before. Okay, compound that. Even though we're not doing as big of a mega backdoor, total contributions is $220,000. In this example, we've created $89,000 of tax-free growth in the account. As I mentioned, this will only compound as we move forward. So with that, I did want to just take a minute to say thank you very much. This concludes the portion of today's webinar about mega backdoor. I do appreciate everyone's patience as we work through some of the screen and technology kind of issues we had today. That being said, mega backdoor, incredible strategy, in-plane conversions, incredible strategy, if it makes sense for you and your personal situation. So we are available at any time. Please feel free to contact us with any questions. We're always happy to review whether this strategy makes sense for you, whether it doesn't, what are the implications. Always happy to help. Here's our number here. With that, I want to say thank you for joining today's webinar. We really appreciate it. Feel free, if you want to get in contact with us, use this QR code. Please follow us. LinkedIn, Facebook, Instagram, all social media platforms. Follow our podcast, The Bogart Effect. And we want to thank you very much for following. Really appreciate it.